Most traders look at a trading range and see confusion, but Richard Wyckoff saw a highly intentional battlefield where smart money quietly reveals its next move. What appears to be boring sideways chop is often the hidden preparation phase before a violent markup or devastating markdown. Picture this. Bitcoin stalls at 60,000 and traders start calling it dead. Yet beneath the silence, volume swells on every dip, supply dries up, and large operators keep buying at the same levels without letting price escape. That isn't random, that's accumulation, the calm before the storm. And when those operators finally complete their tests and spring the range, price doesn't just move. It erupts, leaving emotional traders behind and rewarding only those who understood the true purpose of the trading range. Ladies and gentlemen, today we're stepping into one of the most misunderstood territories in all of trading: the trading range. Most traders dismiss these sideways markets as noise, indecision, or wasted time. But Richard Wyckoff taught us something radically different. Trading ranges are where the real story of the market is written. This is where smart money positions themselves, where supply and demand quietly shift, and where the next major trend is silently engineered long before it becomes obvious to the public. If you can learn to read the intentions hidden inside these ranges, you won't just predict what comes next. You'll understand the why behind every major move. Today, we expose the hidden purpose of trading ranges and reveal the blueprint of what follows. Institutional accumulation is the hidden engine powering almost every major bullish move in the market. Yet it unfolds in a place most traders overlook: the trading range. When Wyckoff studied the behavior of the composite operator COB, he discovered that institutions cannot simply buy large quantities of an asset in a single push. Doing so would drive the price upward too quickly, alerting the public and increasing their own cost basis. Instead, they must accumulate their positions slowly, strategically, and quietly across a broad sideways structure where their true intentions remain invisible to the untrained eye. This deliberate process is what transforms an ordinary trading range into a launchpad for markup. At the heart of institutional accumulation lies the concept of absorbing supply. Early in a range, selling pressure remains strong as weak hands panic, take profits, or react emotionally to previous downtrends. Institutions use this period to soak up every available share without allowing price to escape the range. You'll often see price attempts to rise only to be pushed back down, not because the market lacks potential, but because smart money wants it contained while they continue filling their positions. This behavior creates what Wyckoff called horizontal movement, with rising volume on down bars and drying supply on down tests. A signature footprint of the professionals at work. As the range matures, subtle shifts begin to appear. Downward reactions become shallower, indicating that supply is diminishing. Each test toward the lower boundary shows decreasing volume, signaling exhaustion of weak sellers. Meanwhile, institutions continue to accumulate on dips, often disguising their buying through algorithmic distribution between multiple exchanges or through iceberg orders that hide their true size. This is the quiet war between supply and demand, where the CO patiently waits for the perfect moment to reveal its true intention. Turning points during accumulation often come with events like the spring, where price temporarily dips below the support line to trigger stops and create a final burst of liquidity. Many traders mistake the spring for a breakdown, exiting in fear right before the real move begins. However, to Wyckoff traders, the spring is a master signal, smart money shaking the tree to catch the last pieces of supply before marking up. After the spring comes the test, where price revisits support on low volume to confirm that supply has truly vanished. When accumulation is complete, institutions no longer need to suppress price. They begin marking up the market, pushing it out of the range with conviction. Breakouts become obvious only after the cause has been built. the cause being the entire accumulation phase itself. Wyckoff's law of cause and effect states that the longer and more deliberate the accumulation, the bigger the ensuing trend. That's why powerful rallies often seem to appear out of nowhere. They didn't. They were engineered inside the trading range long before the public noticed. Understanding institutional accumulation transforms the trader's perception. What looks like boring sideways movement becomes a strategic battlefield filled with clues, footprints, and intentions. And to those who can read these signs, the trading range becomes a roadmap to anticipate the next major move with clarity and confidence. In Wyckoff's universe, every trading range is a battlefield where the forces of supply and demand fight for dominance. Most traders only recognize this struggle in obvious trends, when price surges upward or collapses downward. But the true origins of those powerful moves begin much earlier, inside the quiet, sideways structure where supply-demand imbalances are being engineered by the market's largest participants. Smart money uses trading ranges not only to position themselves, but to gradually tip the balance of the market in their favor long before the breakout becomes visible to the public. To understand supply-demand imbalance, we must first appreciate a simple truth. Price does not move because of indicators or patterns. It moves because one side overwhelms the other. When demand exceeds supply, price rises. When supply exceeds demand, price falls. But the most fascinating moments occur when neither side fully dominates, yet, instead, they wrestle inside the range, each probing for weakness. This is where Wyckoff traders thrive, decoding the subtle changes hidden within bars, volume, and reactions. In the early stages of a trading range, supply usually appears dominant. After a preceding markdown, weak hands panic, take losses, or react emotionally. Institutions welcome this behavior because it creates abundant cheap supply they can quietly absorb. During this phase, you'll often see wide-down bars, heavy volume, and temporary support forming near the lower boundary of the range. This isn't randomness. It's the first phase of supply being transferred from public hands to institutional hands. But as accumulation progresses, the behavior of the market begins to shift. Each time price revisits support, volume tends to shrink. Downward reactions become narrower. Sellers become exhausted. Meanwhile, demand begins to emerge silently as smart money continues buying behind the scenes. This shift is the essence of a supply-demand imbalance in the making. It is not yet strong enough to lift price out of the range, but is steadily pushing the market toward a tipping point. One of the most important clues comes from the quality of rallies and pullbacks within the range. When demand strengthens, upswings begin showing wider spreads, cleaner closes, and increasing volume, signals that buyers are becoming more aggressive. On the other hand, retracements towards support begin showing hesitation, low volume, and shallow depth. In Wyckoff terms, supply has been dried up. This is a critical moment. The imbalance has begun tilting in favor of demand, even though the public sees only sideways chaos. The spring pattern is the final and often most dramatic test of this imbalance. When price briefly dips below support, the market triggers a surge of stop, loss orders, and emotional selling. In this moment, supply temporarily spikes, but this surge is quickly swallowed by deep-pocketed buyers, confirming that demand is now overwhelmingly stronger. The spring is the ultimate demonstration of the imbalance. Despite the flood of new supply, the market refuses to move lower. Demand absorbs everything. Once the imbalance fully favors demand, smart money begins allowing price to escape the range. Breakouts occur not because of sudden interest, but because the trading range has completed its hidden purpose: to shift the market from supply-driven to demand-driven. And once the imbalance reaches a decisive threshold, markup becomes inevitable. Understanding the supply-demand imbalance inside trading ranges gives traders an X-ray vision of the market's true internals. Instead of waiting for the breakout, Wyckoff traders recognize the change of character long before it becomes obvious, positioning themselves alongside the composite operator, not behind them. The cause and effect principle is one of Richard Wyckoff's most profound contributions to market logic, and it serves as a powerful lens for understanding the true purpose of trading ranges. According to Wyckoff, the market does not move randomly, nor does it rally or collapse without preparation. Every major trend you see today is the effect of a carefully constructed cause that formed earlier, almost always inside a trading range. When you begin to see ranges not as stagnant sideways chop, but as cause-building mechanisms, you unlock an entirely different level of market insight. In Wyckoff terms, the cause is the underlying preparation conducted by the composite operators ICO. When institutions accumulate positions, they are building the cause for a future markup. When they distribute positions, they are building the cause for a future markdown. Without a sufficient cause, the market cannot sustain a large effect, meaning it cannot run far in either direction. This principle is not philosophical, it is a practical observation of how large operators must act to achieve their objectives. Trading ranges are therefore not wasted time, they are the essential groundwork for the next major move. Every test, shakeout, absorption event, and rally within the range contributes to the build-up of cause. The longer the range, the larger the cause, and the larger the future effect. This is why tight, short ranges often lead to modest moves, while broad, lengthy accumulations can lead to explosive, long-lasting trends. What many traders miss is that the cause is built quietly, in phases. In phase A of accumulation, the market stops the downtrend and initial supply is absorbed. In phase B, large operators work diligently to accumulate shares while keeping price contained. This phase is the core of cause building. Every drop of supply absorbed adds to the fuel for the eventual markup. Volume signatures, the character of rallies and reactions, and the behavior at support and resistance all reveal whether the cause is strengthening. Then comes phase C, often marked by a spring or shakeout, which dramatically enhances the cause by forcing weak holders to abandon their positions. This drop below support isn't market failure, it's strategic manipulation designed to gather the last needed supply before liftoff. When price springs back and retests the area with low volume, it confirms that little supply remains. This successful test marks the completion of cause. Phase D and Phase E, the unfolding of the effect, are where price finally expands outward. But by the time the breakout happens, the cause has already been fully constructed. Public traders notice the breakout only when the effect becomes visible. Wyckoff traders, on the other hand, anticipate the breakout because they recognize the signs of a mature cause long before the market moves. This principle gives traders a logical framework for anticipating not only direction but magnitude. A strong, lengthy cause implies a big effect, a weak or short cause implies a limited move. Instead of guessing, Wyckoff traders measure the cause by studying the width of the range, the volume patterns, and the behavior of supply and demand. In essence, the cause and effect principle allows you to see the market's future by understanding its preparation. When you learn to read cause building inside trading ranges, you no longer chase breakouts. You predict them. You no longer react to trends. You understand why they exist. And you align yourself with the very operators who create the cause in the first place. Understanding composite operator behavior is the key to unlocking the hidden purpose of trading ranges. Richard Wyckoff taught that behind every market lies a single unified intelligence, the composite operator, their CEO. This is not one trader, but rather the collective actions of institutional players, hedge funds, market makers, banks, algorithmic systems, and deep-pocketed professionals. To the untrained eye, their moves look random. But to the Wyckoff trader, their intentions are visible in the footprints they leave behind. Especially inside trading ranges, where they conduct their most important work. The composite operator uses trading ranges for one primary reason: to operate without revealing its plan too early. Institutions cannot simply buy or sell massive positions in a trending market without causing price distortions. If they buy aggressively in an uptrend, the market front-runs them, driving prices higher and forcing them to pay more. If they sell too rapidly in a downtrend, panic sets in, collapsing their own exit prices. The solution: they contain price within a controlled range, where they can buy or sell gradually while keeping the public confused. Inside accumulation ranges, the CO behaves like a silent predator. When price approaches support, you'll see heavy volume but narrow spreads, indicating large buyers absorbing supply without letting price fall further. On declines, volume often spikes. This is not panic selling, but smart money quietly buying from emotional sellers. On rallies toward resistance, volume often fades because the composite operator has no interest in letting price escape until the accumulation is complete. This dance continues for weeks, months, sometimes even years, as institutions build enormous positions at the lowest possible cost. One of the clearest signs of composite operator behavior is the manipulation of public psychology. The CO uses time, sideways movement, fake breakouts, shakeouts, and well-placed traps to wear out weak holders. A spring, where price dips below support to trigger stop losses, is a classic maneuver. It temporarily creates the illusion of breakdown, forcing traders to capitulate. Yet within that emotional chaos, the CO is aggressively buying. This is how they efficiently vacuum up the last pockets of supply before markup begins. In distribution ranges, the composite operator flips the script. Now they are unloading positions without collapsing the market prematurely. They allow price to rise or stay afloat, giving buyers confidence. Each upswing is met with subtle selling, often disguised by algorithmic execution or iceberg orders. The public thinks the market is preparing for another leg up. In reality, smart money is selling into their enthusiasm. Once distribution is complete, demand weakens, supply overwhelms the market, and markdown begins, catching the public off guard every time. The true brilliance of composite operator behavior lies in its patience. The CO doesn't chase trades. It creates the environment for profitable moves. Trading ranges are their workshop, their laboratory, their battlefield. They engineer imbalance, transfer ownership, and control volatility until the market is primed for the trend they intend to unleash. For the Wyckoff trader, the goal is simple: stop trading against the composite operator and start trading with them. By studying their footprints, volume signatures, price reactions, failed tests, quiet absorption, and violent shakeouts, you begin to see what the CO is preparing long before the public realizes it. And once you align with the composite operator, the market stops feeling random and starts feeling intentional. Range breakout dynamics represent the climax of everything that has been quietly unfolding inside a trading range. While most traders believe breakouts are sudden events triggered by news, hype, or random momentum, Wyckoff's teachings reveal a different truth. Breakouts are the final expression of months of strategic preparation by the composite operator as CO died. The breakout is not the beginning of the move. It is merely the public unveiling of a trend that was engineered long beforehand. Inside the trading range, smart money is building the cores, absorbing supply in accumulation or unloading shares in distribution. Throughout this preparation phase, the market appears directionless, choppy, and frustrating. But beneath the surface, the seeds of the coming breakout are already being planted, shaped, and controlled. By the time price finally breaks out, the battle has already been won. Breakout dynamics are the final release of built-up pressure in one dominant direction. A powerful characteristic of range breakout dynamics is the change of character that precedes the move. If the range is accumulation, you will see cleaner rallies, stronger closes, increasing spreads and higher volume as price approaches resistance. Weak hands are no longer dominating the tape. Demand is now silently overpowering the remnants of supply. Conversely, in a distribution range, you'll notice rallies becoming weaker, volume drying up on upswings, and spreading wider on down bars, signs that buyers are no longer in control and supply is preparing to overwhelm the market. The most explosive breakouts are almost always preceded by a final test, a subtle maneuver engineered by the composite operator to ensure that conditions are perfect before committing to full-scale markup or markdown. After a spring in accumulation, price will often retest the lower portion of the range on very low volume, showing that no meaningful supply is left. This successful test is the moment Wyckoff traders pay close attention to because it signals that the composite operator is satisfied with the groundwork and ready to shift gears. When the breakout finally occurs, it often unfolds with decisive price action, wide spreads and expanding volume. This dynamic shift reflects the CO, transitioning from accumulation to markup or from distribution to markdown. Liquidity at the breakout level is thin because the composite operator has absorbed or distributed nearly all available supply. This lack of opposition allows price to slice through resistance or support with ease, creating the illusion of sudden strength or sudden weakness. But what truly defines range breakout dynamics is what happens after the breakout. Strong breakouts tend to retest the breakout zone. In accumulation, the market may pull back slightly toward the prior resistance, now acting as support, to confirm that supply remains dry. This retest, if shallow and low volume, offers one of the highest probability entries in the Wyckoff methodology. In distribution, the opposite occurs. The market may bounce back toward the broken support zone, only to encounter overwhelming supply before collapsing again. These retests reveal the underlying truth: breakouts are not single events, but phases that unfold with structure and intention. Finally, once the breakout gains traction, momentum builds rapidly as the market shifts from the quiet preparation phase to the public participation phase. Trend followers, news-driven traders, and emotional participants rush in, chasing the very move that smart money engineered long before. The breakout is simply the moment when the rest of the world notices what Wyckoff traders already anticipated. In essence, range breakout dynamics are the grand reveal of all the invisible accumulation or distribution that took place within the trading range. They are not chaotic, they are orchestrated. And once you understand these dynamics, you no longer fear breakouts. You position yourself ahead of them. In the end, what most traders dismiss as meaningless sideways chop is actually the most revealing phase of the market. Trading ranges are not stalls, pauses, or indecision. They are deliberate constructions where smart money shapes the future. Inside these ranges, institutions build their positions, manipulate supply and demand, and engineer the very trends that the public later chases. By understanding institutional accumulation, recognizing shifts in supply-demand imbalance, applying Wyckoff's cause and effect principle, decoding composite operator behavior, and mastering range breakout dynamics, you gain access to the market's hidden language. You stop reacting to the effects and start recognizing the causes. You stop trading in confusion and begin trading with intention. And most importantly, you align yourself with the forces that actually move the market. When you understand the true purpose of trading ranges, you begin to understand the market itself.